Okay, thank you. And it's going to Echo 360? Okay.
I feel like a paragraph is technically more than 2 sentences.
It's not. Technically, it's 2 sentences.
Really?
Dr. Ritchie, this paragraph is technically 2 sentences.
3.
It is 2. That's okay. If you want it to be 3, it'll be 3. I guess there's a financial
Yeah. I think I learned that in elementary school, maybe. I don't know. When did you learn to write paragraphs? I don't know.
Well, what is your definition of a paragraph?
I guess it doesn't matter what other people say. It's just what I say.
Right, exactly.
What is your definition?
That's what I mean. If she thinks it's 3, then it's 3.
I'm still learning to write paragraphs.
That's all right.
Still working on that.
This is for which one? That
I'm
thing?
trying to figure out what we have to review this week going into next week.
So the only thing that's due this week is Sunday night is the derivatives one, the movie. And that's the one that you're saying, because I think I put on there a paragraph per item.
Yeah, so that's deliverable 6, and then 5.
And then 5 will be after that. So I swapped the order of deliverables 5 and 6.
Even all the prep stuff for that delivered, so those videos and everything, so everything for Unit 6 is this week.
Well, no, because I'm not going to talk about it until we get to it. It's just that the deliverable itself is easy. You can do it without me. You don't need me in order to do that deliverable. But you shouldn't try to get caught up on the readings associated with deliverable 6, because we're not going to even touch that until that last week of class. So read the stuff that's associated with deliverable 5, which is fixed income. And the reason I want to give you more time on that one is that the assignment itself is more involved. So I feel like it's not enough time to give you only a week to do it. I don't mean that you should wait until next week to start it. So I probably wasn't clear.
You should probably start this week as well.
I think you should start 5 this week.
Okay.
Just knock out deliverable 6. It'll take you 50 minutes to watch the video and probably another 45 minutes or so to answer all the questions, and you're done with that. But you don't need to do the readings associated with that, because I'll get to that the following week. Was that clear to everybody? It's not really all that clear. I can hear myself speaking, and I can hear myself saying something that's unclear. Huh? Should I draw it? I should probably draw it. Anyway, so where I'm at right now is we're still in Unit 3, which is the asset allocation. I knew that was going to take me 2 weeks to do. So I want to finish that and then possibly talk a little bit about what out of Unit 4. But if I don't get to Unit 4, you have enough in there that you don't actually need me to talk about it. So you can do Unit 4 all by yourself, because it's really the efficient market hypothesis and the different forms of the efficient market hypothesis. Weak form, semi-strong, strong form. So you don't really need my attention on that. Where you do need my attention is in Unit 5 and then in Unit 6. And Unit 5, the assignment itself is a little bit more involved only because there's math. So that one requires more than just a week out of you. And so if you wait until the day before that one's due, there's no chance that you'll be able to finish it. You won't, unless you actually already knew this stuff, in which case you probably didn't need this class anyway. You were fine without having been here. So I would say when you leave here, so I don't know when you guys normally start working on your finance, but assuming you start tomorrow on finance, I would start by knocking out the video and the assignment for Unit 6. You can do that in one evening and be done with it. And then the next night, just start with Unit 5, reading the stuff, trying to understand it, and then see if you can watch. I've demonstrated how to do the homework assignment. I've posted 2 videos on how to do it. So if you watch them and then you try the assignment, it should follow. But if you just try the assignment without the videos, it'll look way more confusing. So if you watch me do it and then you do it, hopefully it's a little bit better. So I don't know that I was any more clear, but we'll go with that. Anyway, nice to see you guys. I see I have a couple people here online. Hey, Crystal. Hi, Sunil. And I think that's, just the two of y'all are joining us. I'm a little bit like lower energy today because I got here from San Diego this morning. I came on the red eye, and I arrived at 8:30, and I've been at work. My husband dropped me off at the office, and I think I'm getting older. I think that's all it is. I think I'm not as young as I used to be, and so I get tired more quickly. I think I could have done this years ago and not have thought about it.
I literally was just in Las Vegas the last several days, and I found that for the first time ever, that I actually suffered from jet lag.
I think that's what it is.
I was up at like 4:30. I'm like, I'm in Vegas. It's like Vegas day 0. It was awesome.
No, I think I'm just discovering that I'm not 25 anymore. That's all.
I know.
And so you will discover it with me as we suffer through the evening, and you're watching me fade. I was going to say at our age, but I'll take it back. At my age, when you don't get enough sleep, you start feeling like you have the flu. Like that's actually what starts to happen. Where did I leave you? I left you with, the big fancy formula, completing the square.
You left us with
Huh?
You left us with row.
Row.
Yeah.
And you were going to try that calculation on your own and see how far you got. How did it work? Missed that part? Everything's always yeah. It's like when you ask your kids, do you want to clean your room? Like that was a recommendation. It wasn't actually a command. We calculated putting two risky assets into a portfolio. So let me back up for a minute and give kind of a quick overview of where we are. In portfolio management and asset allocation, we're combining assets. And by assets, I mean financial assets, stocks and bonds and cash and whatever. We're combining them to create the best possible mix. And there are really, I guess, 3 components. There's the possibility of 2 different risky assets, and then there's a third asset which is risk-free. So when we put risky assets together and create this risky portfolio, it could be 100% in one stock, or it could be 50-50 in 2 different stocks, or it could be 10% in 10 different stocks, or it could be all 500 stocks in the S&P 500, whatever. It's some risky portfolio. When I combine it with the risk-free asset, I can shift my asset allocation, some of my money in it, some of my money in the risk-free asset, and I can come up with my expected return next period and the level of risk that I'm facing. And when we did that, we put together basically a expected return standard deviation where one of our assets is risk-free, the other one is risky. It has some level of expected return and some level of risk. And we can shift our portfolio along this capital allocation line. We can put 100% of our money in the risky asset P, or we could put 100% of our money in cash, or we could do 50-50, or we could do 120 and minus 20. Right? And we were just shifting along this capital allocation line where is the proportion in the risky asset P standing for portfolio, and 1 minus Y is the proportion in cash. I keep switching from uppercase to lowercase, and I know that can drive people crazy. Risk-free asset. And so this was called the capital allocation line. We can estimate the expected return of the combination of those two was how much in my risky and how much in my risk-free asset, and we can estimate the level of risk. Oh, that's a P. Okay. So this is created by combining a risky and a risk-free. And then the next thing I did the last time we met was I wanted to form this. I wanted to create that. And I did that by just combining two different risky assets. And we said that the expected return of some risky portfolio is however much money I have invested in the first risky asset times its expected return. So it's a weighted average of the expected returns of the risky assets I have available to me. And then we said that the standard deviation, we didn't start with standard deviation, we used the variance. But basically the variance is that's rho. That's the variance. If I want to get to the standard deviation, I have to take the square root. And I didn't have that up on the board the last time. I think I just stopped at variance, and then I said that the standard deviation was the square root. Here I just wrote it up one time. So this is how I form that. That's how I form that. And what we're saying is I can add a bunch of stuff and achieve a target expected return of a portfolio. And as long as all those returns are not moving perfectly in tandem with one another, I can reduce this by causing this term here to be a little bit lower and lower and lower. And so I can create a portfolio where I am minimizing risk and I am maximizing return. And that's very rational. That's what a rational investor does. They maximize their expected return and they're minimizing risk. And you can kind of see why the behavioral finance people say this is all hogwash, because the average investor doesn't do any of this stuff. Right? But as long as somebody does, there is some truth to this. As long as there are people out there doing it, it can actually happen. And so think about how people might actually do this. Well, if an investor comes to an investment manager and says, in order for me to retire at this age, I need to have this much money. How are you going to get there? Well, here's what I have now. Here's what I want to have then. I need this to grow to reach that. Well, it needs to grow at a certain expected return. So we've just identified the target. And so we say, well, how are we going to create a portfolio that's going to achieve that? Well, you obviously can't park it all in the mattress, because this certainly isn't going to do it. That's not going to do it. So I need to find you assets. And so we build the portfolio, and we keep adding assets to this portfolio. And if we had three assets, we'd have the weight of A, the weight of B, and the weight of C. If we had 100 of them, we'd have A and B and C all the way out to the 100th. But then can you start to see what this would look like? This would be A and B. We'd need one for C. And then what we have here is twice A and B. I would have to have twice B and C. And I would have to have twice A and C. I'd need all of them. So if I had 100, can you see what a computational nightmare that could be? And where would we even get these numbers? Well, in reality, what you do is you use historical numbers to try to estimate that. That's what you do. So you run a big, giant spreadsheet with whatever, a year, 10 years worth of numbers and capture the variances, and you capture all the combination of covariances, and you plug them. And if you have a computer, you can do this. It's not really that bad. Back in the day, it used to be a real nightmare, but today, you know, the laptop you buy your kids when they're in elementary school can do some of this stuff. So, but you can see what's required. And so some portfolio managers will actually have all those variances and all those covariances in some kind of database where they are able to pull out all the possible investments and build for you your possibilities. And what they're doing is this on kind of a bigger scale, because the next step is to take this and plot it. So when we plot our risk-free asset, our risky assets, A and B, if I just use stock A and stock B, let's put expected return of A here. This will be stock A. And this will be the standard deviation of A. And let's put B here. And this will be the expected return of B. And this will be the standard deviation of B. And then what we do is this. We plot out what my portfolio's expected return and standard deviation would be if I shift W. So if I put 100% of my money in A, 0 in B, I'm going to end up with this expected return, that risk. And if I put 100% of my money in B and 0 in A, I'm going to have this expected return and that risk. And then if I were to put some combination, and I think the example we did last time was how much? I'm looking at the wrong sheet. 50-50, I think, in your notes from the last time. Did we do 50-50 in A? The weight of A was 0.5.
70-30.
We did 70-30? 70% A, 30% B?
Yeah.
Okay, so we said had it been 70-30 even up, the expected return would have been, had it actually been perfectly positively correlated? Do you remember what the expected return was? Is that right? And then what was my level of risk? It was like 19.6 or something? 0.196 if rho was 1, and then the real one was 0.186. Okay, so this was 0.196, but then that was if rho was 1. If rho had been 0.5, so they are not perfectly positively correlated. Had rho been 0.5, your actual expected return would have been the same, but your risk would have been 0.186. So rather than do this, it did this. And so what you would do is, what if the correlation was less and less and less and less, like you just kept varying it? You'd be able to find that had the correlation been even less than 0.5, it wouldn't have been here, it would have been out here somewhere. And had it been negative, it would have been like way out here somewhere. And you'd find that this trade-off between return and risk bows to the left. So if correlation had been 0.5, and what I guess, did anybody try it? Had the correlation been 0? If you didn't get a chance to try it another time. But had you tried it, if correlation was 0, you would have found that the risk was like 0.176. It would have been out here. And what you're finding is you can reduce the risk and maintain the same level of expected return. You can keep shifting the risk and maintain the same level of expected return. Because what you're doing is this little part of risk is getting smaller and smaller and smaller. Right? As this one number gets smaller, this gets smaller, and that gets smaller. So as correlation declines, then this term here that declines. And the whole thing goes down. Everything goes down. So as correlation goes down, this term, the third term, gets smaller, making the whole amount of risk get smaller. And what we're finding is you can still deliver a portfolio with a 12.3% expected return with less risk. So your job as an investor or your job as an investment manager is to find assets that are have as low a correlation as possible. That's your task. And so you might pull returns on different asset classes going back in time, and you try to find stuff where the correlation is very low. And that's what we talked about the last time, where we said, what happens if they're not low? Well, all of a sudden, your same expected return comes with a boatload of risk. Right? Your risk just went up dramatically. So your whole job is to try to find assets that are lower in correlation. And so people add things like private equity and real estate and commodities and emerging markets, right? And currencies and farmland. Right? We add assets that presumably when markets go up and markets go down, they don't all move together. Right? So if you had $1 million, you do not put all million in the same sector of the market. You spread it around. And the whole reason you're spreading it around is you're looking for different categories of assets that have lower than perfect positive correlation. This is where we kind of left off. So if we pick one, so let's just go with one.
Let me ask a question here.
Mm-hmm.
So, what about when we pick a portfolio that is so non-correlated that our return goes to zero?
You need to shuffle the weights so that they're not zero. You have to shuffle the weights so they're not zero. So let's suppose we picked, for simplicity's sake, we found two assets, and they not only are low in correlation, they actually have a -1 correlation. That's that's totally false, but let's suppose we did it. So the correlation is -1. And so it doesn't vary. So here's A, here's B, right? And what you would do is plot out all the possible weights. What if W, okay, well, it's right there. What if weight A is 0.7 and this is 0.3? I'll find that it's not on this line. It's out here somewhere. And you keep going. And you find it's like out here somewhere. And you keep doing that. You keep shuffling. You keep shifting the weights. And what you're going to find is there's a point. It's going to look like that. And you can try it. If you have a spreadsheet and you have a computer, you can try that. What you're going to find is as I shift the weights, I'm going to get to a place where I have completely offset the risk, but I'm going to still end up with an expected return because none of these are risk-free. All I've done is offset the risks, one from the other. We call this one the minimum variance portfolio, and you can actually find it mathematically. You can find that. You just set, if you know any math, like your old calculus, you can find that minimum variance portfolio. Or you can use Solver in Excel. So you solve for which W will give you a variance of 0. Right? That's what you're doing. But it's still not impossible. It's not a 0 return. All you've done is said that the volatility of one is offsetting the volatility of the other, but there's still a return. And so if you want more than that, you just need to find the W that works for you. This is if correlation was equal to -1. This is an impossible situation. In reality, most stocks, correlation is about that. That's about normal, about 0.2. So in the S&P 500, just pick any 2 stocks or pick any 2 indices, and it's going to somewhere be give or take, right? If you pick Pepsi and Coke, it should be higher. But Pepsi and any random other company, it should be somewhere in that neighborhood. Now, with the 0.2, it's still going to not be that. That trade-off isn't going to exist. It's going to still bow out to the left a little bit. It's still going to bow a little bit. So as I shift my W, so this is WA is 1. This is WA is 0.7. Here's WA is, 0.5, and you just keep shifting it. You're going to find a point that's as low as it could be. Right? There's a point where it's as low as it can be. That's what's called the minimum variance portfolio. That's the minimum variance portfolio. There is some combination of weights where I can get my risk as low as possible. You just need a spreadsheet to do it. You need Solver to do it. There is some combination of weights that will get it so that I cannot do any better in terms of risk. I can drop my risk as low as possible and still have an expected return. So that is a portfolio. This portfolio, whatever the weights are, we didn't solve it mathematically here, but we can. It's going to have some WA and some WB, and it's going to be some combination. It's probably like 15% of B and 85% of A, whatever it happens to be, and we're going to find it. And then what we're going to say is, let's call this portfolio, let's give it a name. Let's call it M. And this is A, and this one's B, and this one's A. Which would you choose, portfolio M or portfolio B? Always. M dominates B. Remember how I started this whole conversation? And by conversation, I mean me talking. Remember what dominates something else? I can always, whatever I think I can get with B, I'm going to always do better with M. So it is not smart for me to put 100% of my money in B, even though B is not that risky, because I can actually do better in terms of risk and better in terms of expected return if I put just a little bit of the money in A as well. That's the impact of diversification. Even if you think bonds are as safe as you can be, you're still better off putting just a little bit of your money in something else. Something else. Huh? The craps table? Maybe not. But something. And you probably do have a little bit of money in something else, whether you think you do or not. You do actually have money tied up in your real estate, and you probably have, you do actually have a little bit of a diversified portfolio, whether you realize it or not. You're not completely tied to any one asset. But the point here is this will always dominate B. So even though these combinations, meaning 100% in B, 99% in B, 98% in B, every one of those up to that minimum variance portfolio, even though they exist, no one's going to invest in them. So we might as well not even bother putting them on there. So you could do that if you wanted to, but nobody would invest in them. They're not what we call efficient. Those are inefficient portfolios. You can do better in terms of risk and return. You can do better than that in terms of risk and return. This combination that I just drew is called the efficient frontier. This is called the efficient frontier. And it's named after Markowitz. Markowitz's efficient frontier, because he's the one who first drew this out. So the Markowitz efficient frontier, all it did was, and he did it not just with 2 stocks, he did it with all the stocks he could get his hands on. And he plotted every possible risk and return trade-off for every possible weight. We just keep changing the weights and plot and plot and plot and plot. And so the real efficient frontier, I'm going to start back over here. So I keep working left to right. So let me start back over here. The real efficient frontier does this. And you do this with a big computer algorithm. You find the expected return and standard deviation of every possible asset that's out there. Portfolio A, and B, and C, and D, right? Every one of them. All 500 in the S&P 500. All whatever many thousands there are. You just keep plotting them. And then you start shuffling the weights. You say 99% in A and 1% in B. What's that one going to look like? Right? How about 70-30? How about 70-10, 10-10? Right? So you just have a computer generate all the W's, all the possible weights. And what you're going to find is they're all going to fall here somewhere. Right? Some are going to be out here. Some are going to be wherever. They're going to be all over the place. Right? Some of these have 100% in some oddball security. And 90, 10, 10, and whatever. You have all these possible weights. And what you're going to find is there is a level at which you can't do any better. And that's the true efficient frontier. That's the true efficient frontier. And there is in that efficient frontier, again, if you just use a solver, but you just use it with a better program than Excel, you'll find the minimum variance portfolio. So you can do this. So I've seen money managers do this with the S&P 500. All 500 stocks, shuffling all the weights over and over and over again until they can plot this. And then you find the best of everything. Right? And we plot that. And so this becomes the minimum variance portfolio. But the question of which of these should you choose, you can't answer. I can tell that MVP dominates B. And I can tell that this dominates C, but I really can't tell if MVP dominates A. I don't know that one. Now that depends on my indifference curves. Are you with me? Now all of a sudden it depends on how risk averse I am. If I'm highly risk averse, I'm going to have a very steep indifference curve. I'm going to be down here somewhere. If I am highly risk tolerant, I can handle a little bit of risk in my life. My indifference curves will be flatter. I'm going to end up here somewhere. But we are not going to choose the same W's. We're not going to create the same portfolio until we bring back into the picture the risk-free asset. And now, if I introduce this risk-free asset again, and I say, what if I just put some of my money in this and some of my money in one of these? I'll pick one, this one. What if I put that proportion in the minimum variance portfolio and 1 minus y in the risk-free asset? I can do that. And then I can shift y, right? That's 50% in the risky portfolio that I just created, 50% in the risk-free asset. I could actually do that, right? You remember that? That was using margin. But that's not efficient because I could have done better right here. So that's not useful. So minimum variance portfolio is really not a great idea because I can do better, right about here somewhere. So what if I pick a different combination of W's? Right. Again, I can do better. I could keep extending this until I find the portfolio that's tangent. I can find that one that's tangent. And you can do this again in Excel. Like I keep saying, it sounds like a fancy mathematical thing, but it's not. All you do is you find the point, again, using solver, where the slopes are equal. Right? Just you're finding, so if you guys remember back in the old days, your old math, you're just setting the slope of the one equal to the other. And I can find this tangency portfolio. And now, if I'm very risk averse, and I can't tolerate that much risk, I can put maybe 50% of my money in this tangency portfolio and 50% in the risk-free asset. I will end up with the level of risk I could have tolerated, but better expected return. And if I was highly risk tolerant, like maybe you're an entrepreneur. Entrepreneurs are people who have, they often are really good at evaluating risk, and they are able to tolerate risk. Like they kind of know how to handle it. It doesn't freak them out. So if you're that personality and you can kind of handle it, you would have been satisfied up here. But now what you could do is say the same set of W's on margin. And now you can get the same level of risk you would have been satisfied with, but better expected return. And now all of a sudden, we're all talking about the same risky asset. And we don't care about all these anymore. And this one, we call this the optimal risky portfolio. Okay. And what Tobin, an economist, came up with was this. Based on this modern portfolio theory, investing comes down to two choices. One, so investing. Find it. Find that tangency portfolio. And then decide how much of your money to put in P. In other words, determine Y and 1 minus Y. And this is called Tobin's separation theorem. I think I might have spelled that wrong. How do I spell theorem? E-O? That looks better. Tobin's separation theorem, which has led to the mutual fund industry. This is the reason for the mutual fund industry, is Tobin's separation theorem. What started out as modern portfolio theory, where everybody was trying to determine, do I put weight A as 100? Is weight A 90? Is weight A 80? What about B and C? What about the other 500 stocks? When you plot them all on a big graph and you find your tangency portfolio, we pull that out and we call that the optimal portfolio. And what that's generated is a huge industry that invests in a mutual fund that's effectively the same mutual fund. You go to T. Rowe Price, and you go to Janus, and you go to Fidelity, and they all have the S&P 500, right? All of them. It's pretty much the same investment. And they don't even have to call it the S&P 500. Whatever it is, when one guy's doing it, the other guys are doing it. They're all effectively the same thing. It's the market portfolio. And so the world of investing has been separated. 2 decisions. One is find the market basket, and then determine how much of your money you want to put in the market. Find the market, and then determine how much of your money you want to put in the market. Some of us will put 70% in the market, that's Y, and 30% in cash. Some of us will put 120% in Y, and we're going to borrow 20% in cash. That's the hedge funds out there, the long-short funds. They're going to move out. They're going to be 120-20, 130-30. They'll put 130% of the money in the risky asset, and they're going to borrow 30% of the value in cash. The rest of us can't do that. We can't totally leverage ourselves like that. But effectively, we have separated all this stuff into that. So how did we get to that? You needed expected returns of everything. You needed variances of everything. You needed, correlations of everything. So that's modern portfolio theory. And that's why when they're talking about the behavioral finance and people don't do all this, well, think of all the theories I've thrown at you, all the economics I've thrown at you in 2 hours, right? Last time and this time. I threw a lifetime of finance at you in 2 classes, effectively. We talked about utility and risk aversion leading to indifference curves and expected returns and variances and correlations and covariances, right? All this stuff was thrown at, and I didn't even plot an actual indifference curve. I just showed it to you. There's a formula for that, right? We need like a utility function. We didn't even talk about that. All that math leads to this, this investing theory. You look like you've got something on your mind.
I'm just saying, but you make these huge assumptions.
Yes.
That if
What?
you believe in rational theory, that's fine, but the expected returns can change every day.
Right. And we're assuming that those correlations are pretty stationary.
Right.
And that we know them, right? We've made that assumption. We're assuming that people will maximize return and minimize risk. We've assumed that a rational investor will choose to the northwest in that grid. But some people don't. Some people just like the feeling of risk-free. Like there are some people who actually like taking risks. They like skydiving and all that. So it's not rational. They're not necessarily going to maximize return and minimize risk. But all of that is in there. You're right.
then again, the risk-free is a misnomer because
There's no
of all
truly
the
risk-free.
risks that are associated with it, or whatever that may
Yeah,
be.
and I think we've come down to saying, well, basically it's cash. Like whatever cash is for you is your risk-free asset. If it means putting it in a bundle and stick it in your mat, unless you're in Venezuela, and then you don't do that. Huh? Put it in wheelbarrows?
I said, if it's at Lehman Brothers. Or
Oh,
something
yeah.
like that, right?
But I mean, even cash is a problem. Okay, so all that was modern portfolio theory. So how do you use it for us? You should be able to calculate the expected return and standard deviation of a portfolio. So that gives you P, right? So this is determined by the expected return of the portfolio, weight A, etc. Right? That's how you got to this number. And then you can calculate the standard deviation of P using that formula over there. And you could, if you knew this and this, then you could calculate what it would be with Y, if you can shift within Y and 1 minus Y. So you should be able to do all of that, and that's what the sample problems give you. So there's some practicing to do, I think. Next, Sharpe ratios. Bill Sharpe, whose textbook I used when I was in college, it was actually the Sharpe's textbook, I remember that. He said that this is way too mathematically cumbersome. There's a much simpler way. Because at the moment, you have tons and tons of these calculations to do in order to get to the return and the risk. So here's what Sharpe said next. How about I start over and move? So where Markowitz plotted the y-axis as expected return and the x-axis as standard deviation. This was Markowitz's space, right? Can you read that? That's a lot of parentheses, but can you read what I just wrote in math language? The efficient frontier says that expected return is a function of standard deviation. That expected return that's the risk. So in other words, when risk goes up, expected return goes up. When risk goes down, expected return goes down. That's the Markowitz world. Bill Sharpe came along and he said, no, expected return is a function of not total risk, just the risk that you cannot diversify away. Just the risk that you are stuck with. Just the risk you are stuck with. And he calls that systematic risk. So in other words, it's driven by the risk that cannot be diversified away. That's what he said. So here's our risk. Remember all the different things that went in there? There was, some of it was driven by, right? Some of it was driven by that. Some of it was driven by that, etc. Some of it was driven by that, all the way out. right? But if we were to have a 500 stock portfolio, we're going to have 500 of those. Then, right? Then we have all these. We have all these. We have the covariances of everything with everything else. So if we say that if we call all of this the market, and we want to add one more stock to the market, all of those together are really the market. And we want to add stock I to the market. I want to add the 501st stock to my portfolio. When I look at everything that's in there, though it's not going to matter how risky stock I is. In other words, it doesn't matter if the variance for stock I is really big or really little. What matters is how related is I to everything else. What's its covariance or correlation to everything else? So then this is not important, but is important. It doesn't matter so much if it's a highly volatile stock. What matters is how correlated is it with the market. This becomes what's important. This I can deal with that. It's going to some of that's going to go away. It's going to get diversified away. This is what I'm stuck with. This is what actually matters, is how correlated it is with the market. And so what Bill Sharp was saying is expected return the reward is proportional to the important risk. Reward per unit of risk is it's proportional to the important risk, not to the total risk. Now, do you remember the reward to risk ratio that I introduced, I think, last time? The reward to risk ratio, it was the slope of the capital allocation line. The reward was what we called the risk premium. That was in the numerator. It was the expected return minus the risk-free rate. That was the reward. And what we had in the denominator was risk. And back then, I had total risk. I had the standard deviation. Well, what Bill Sharp said is it's not the standard deviation. That's not what matters. What matters is the covariance. So this is the reward for investing in stock I. We call that the risk premium. Right? That's the risk premium for stock I. And here is the risk associated with adding stock I to the portfolio. That's what matters. So what I'm getting to is the capital asset pricing model. Almost there. Because Bill Sharp went on to say that reward per unit of risk, it's proportional for all stocks. That ratio is the same for the whole market, everybody. So that reward per unit of risk, it's if the expected return for Dell minus the risk-free rate is proportional to Dell's covariance with the market. And it should be the same as the expected reward for, who else? GE. GE's contribution to the risk. So we can simplify that to any stock I. And we can do that for the market overall, is the same as the risk premium for the whole market. Which is a silly thing to write. The covariance of the market with itself. Does anybody know what that is? The covariance of the market moving with the market. Not yet. It will be 1 in a minute. It's actually the variance of the market. That's the variance of the market. And here's the foundation for the capital asset pricing model. I can rearrange that and get to the CAPM. I'm going to rearrange this right now. I'm just going to do a little algebra. I'm going to isolate expected return of I on the left, and I'm going to put everything else on the right. Okay? So those of you that know algebra, I just want to rearrange this. Okay, so that would mean multiplying both sides by sigma IM. Right? You're with me on the algebra side? I want to move this over here. Okay, I just moved that over, and then I'm going to add here, I'm doing this. Let me write this more cleanly. Let me just write it more cleanly. And then I just want to add the risk-free rate to both sides so I can get that out of here. Can everyone see that? That's all I did. I just did some algebra. I just moved the stuff around so I can get the return on one side and everything else on the other. And we call this beta. That's beta.
Why isn't the one on the right? Or I guess why is it not still over O squared?
Sigma squared m. So if I multiply by sigma IM here, it takes it out of the denominator, and it puts it in the numerator up here. That's what I did.
I guess why is the portion on the right not over there?
It is. It is. This is the same as saying, it's the same thing. Mm-hmm. That's the same thing. I was just trying to write it in a way so that you could see beta in all this.
Right. Okay. So if it was word operations, you could just go
Either way.
IM over square down.
Yep.
And then multiply that, and that's the same result.
Right. So 2 times 3 over 6 is equal to 2 times 6 times 3, right? I said it right. I wrote it right. I said it wrong.
Okay.
Right. So that's all I did up there was I moved this so that you would see that this is beta. This is beta. So you guys in your project are going to calculate beta by hand for your stock. And the way you're going to do it, is that you, Brian? What you're going to do is you're going to find a stock that you feel like doing your project on. And you're going to calculate its expected return. And you're going to calculate its variance. And you're going to calculate its covariance with the market. And we're all going to just use the S&P 500 as our market. So you're going to download the market. That in itself is an assumption, by the way. Right? It may or may not actually be the whole market. The market is bigger than the S&P 500. But we're going to do that for our purposes. And you calculate the covariance in one column. You're going to get the variance of the market, and you're going to divide them. And you're going to see that that is your beta. You're going to get a beta. And then you're going to do it another way. You're going to use regression and find your beta. And then you're going to go to Yahoo Finance or wherever you want to go and find their beta. And show me that those three numbers are pretty close to one another.
When you say do it by hand, you mean we're going to do it through Excel?
With Excel. Yeah, you're not doing this by hand. You're going to do it in Excel. That is by hand. So this is, we call this the capital asset pricing model. This is the capital asset pricing model, or CAPM. And we write it more simply as the expected return for any stock I is the risk-free rate plus beta times the expected return of the market this is the CAPM. And basically it says this, the expected return of a stock, some portion of that, of what you would expect, is at least the risk-free rate. So if I invest in a stock, I should at least expect to earn the risk-free rate and then some. How much more? Well, it's proportional to the risk. So I should expect to earn some portion of the market's risk premium, depending on how much that stock contributes to the market's risk. So if I invest in a stock, I should expect to earn at least the risk-free rate and then some portion of what the market generates. This is the market's risk premium. If I'm as risky as the market, I'm equally risky as the market, I should expect to earn the entire risk premium. If I'm less risky than the market, I should expect to earn less than what I could have earned in the market, and so on. So we call a very low-risk stock, we call that a defensive stock. We call it defensive. So you should not expect to earn everything that you're going to earn if you invested in the S&P 500 if you invested in a stock with a beta less than 1. And greater than 1, we would call that aggressive. And so if beta equals 1, you're equally risky as the market.
Beta is the ratio of covariance to the variance.
Yes. Yes. That's all it is. That's all it is. So if you are just as risky as the market, can you see that basically the covariance of whatever stock with the market, if it's the same, that just means that you're just as risky as the market. I'm using a circular argument in a sense. All I've said is that when stock I moves, it's moving the same as stock M. It's effectively the same thing. The correlation is 1. It's effectively the same thing. You may think you've invested in a 501st stock, but you haven't. You've just invested in more of the same. It's pretty much the same market. The only way it's different is if it doesn't move the same as the market, in which case this is greater than that or less than that.
The case where we're trying to calculate is the market value of your token. Well, the market value is going to be
It's going to vary also because you're going to download the S&P 500 over the last however many years I put in that project. So you're going to download prices. You have to change it to returns, but you'll have the return from last week and the week before and the week before and the week before going back 2 years or 5 years, right? And they move. Some weeks it's high, some weeks it's low, some weeks it's positive, some it's negative. And then you can do the same for a stock at the same points in time. And if they pretty much, every time this moves, and they move to the same degree, then you can kind of see that if you put half your money here and half there, it's as if you put all your money in the stock market. There was no diversification benefit, nothing further. It's just it's a mimic of the stock market. So when you invest in these large cap stocks, there's a good chance that they're mimicking the market is being driven by a lot of the large cap stocks. I mean, they're not that different, right? But when you invest in lumber, there's a good chance you're now different, or gold, or whatever, African stocks, or the Egyptian stock market, or who knows what.
Do you want us to choose a stock that's in the S&P 500 would be my first question. And secondly, do we need to choose a domestic stock? I mean, if we use one from Africa, then
you can use whatever you want.
All right. When we did the standard deviation last week to get the variance, we did not use a weighted average. That's when we use the.
You used the A and
right.
Yes.
So when a portfolio to get the beta of a portfolio, do we do the same? Are we using the simple weighted average there? We do the same kind of thing?
No. To get the beta of the portfolio, you don't have to go through the combining and finding and mapping a tangent line. I used to do that to former students, and I don't do that to you guys anymore. Instead, all I want you to do is take the covariance and the variance and divide them.
No, I just meant, not outside the project, I guess, if you were trying to calculate the beta of a portfolio of 100 stocks, would you use a simple weighted average for the beta, or would you have to go through that or different calculation?
You would actually have to go through that calculation if you wanted to find the true variance of that portfolio. Yeah. So that means you would need to feed your computer all your expected returns and all the correlations across the assets. So it's probably easier if you did asset classes. So if you don't have 500 stocks, you have 4. You have large cap, small cap, bonds, and emerging markets, or something like that, right? So you don't need to feed it every single large cap stock. You can just call it the large cap market, and in that case, you can. In fact, I think a lot of the money managers I know, they've pretty much taken the market and broken it up into like 11 things. And so they're not hand picking anything. They're picking ETFs. They're using ETFs to be, here's large cap, here's sectors, here's whatever. And now it's manageable. And then they do all this. Then they do this. Now, this is how we would do it using this formula. And like I said, in your project, you're going to do that. The other way to do it is to do it empirically, where you find the regression line. So you regress. You call this your y variable. You guys have done a regression by now, right? In one of your other classes? You make this your y variable, and you make this your x variable. Right? That's what you do. So you do this. You shuffle it around. I can't use expected if I'm going to do a regression because I'm regressing on historical numbers, not on future numbers. If that, right? So it represents the same thing. It's the return on the stock, but I'm using historical. So what I need to do is RI minus RF. I can't use expectation now. I need to use historical. I make that my y variable. I make that my x variable. And I run a regression. And when you run a regression, you're also going to get some error terms, right? And you're going to plot the best line. So you're going to actually do this. RI minus RF, RM minus RF, and you're going to take your series of returns that you have, and you're going to strike this best line. And you're going to do that in Excel too. That's part of your project. You're going to find this, and you're going to find, there's your beta. And this is what many investors call their alpha. So you hear about these portfolio managers that are going to generate positive alpha. That just means that even when the market risk premium is 0, they have generated some kind of positive return. That's alpha. I'm sorry, Clem. Okay. We call this the security characteristic line. And it's really just a way of showing the relationship between the stock and the market. And when you do this in Excel and you capture the slope of the beta, you should get dead on exactly the same number that you get when you do this. It shouldn't even be close. It should be like spot on the same number. Right? Now, it won't be, if you go to Yahoo Finance and you see what the beta is of a stock, it's going to be close to those, but it's not going to be, that won't be spot on. Can you imagine, why would it be different? If I go to Bloomberg or if I go to Beta and I get their beta.
Using different data, for instance, might be using monthly versus daily data.
Right.
And or they could, I believe Yahoo uses like 36
right.
Months data.
So they use about 3 years worth. I don't know what I asked y'all to do. I think maybe I said 2. And I think I asked you to use weekly or?
5 years.
I said 5 years.
5 years and monthly adjusted closing price.
Monthly. So I think Yahoo uses weekly and they'll use 3 years worth. And someone else may use daily and they may use a year's worth. Right? So depending on what data set you use, you will get these slightly different numbers. Theoretically, they shouldn't be different. Theoretically, they're supposed to be it's supposed to be a stationary thing. You know what beta is. That's one of the arguments why people don't believe in any of this, is it's different depending on which time period you chose. It doesn't satisfy the rules. But basically, for those of you that are interested, when someone then talks about the systematic risk, we also call that the market risk. We call that the non-diversifiable risk. And that's captured with beta. That's beta. So it has high systematic risk when that beta is really high. In other words, the slope of that line is very steep. That would be a high beta stock. Right? It would be really steep. Every time the market risk premium goes up by 1 unit, that stock's risk premium would be expected to go up by 2 units. That would be a very risky stock because that means every time it goes down by a unit, you go down by 2. Right? So that's risky. We call non-systematic risk systematic. We call that the unique risk. Or we call it firm-specific risk. We think that is diversifiable. And mathematically, that is captured with how far these dots fall around the line. It's the dispersion of these dots around the line. So a stock has very high unique risk or very high non-systematic risk if that scatter plot is really widely dispersed around the line. And it has very little unique risk if those dots are all really clustered close to the line. Can you tell how I might mathematically capture those? How would you put a number on that dispersion? Like if you were going to try to tell somebody, you wouldn't be able to explain to them, well, it's really widely dispersed around the line versus really narrow. What's a number? The standard deviation of what? It's of the distance. So that's called a residual. Do you remember that in your regression? A little bit? So maybe not standard deviation. Some people just call it the variance of that residual. The variance of the residual. The reason we use variance, if I took the average of the residuals, what should I get? What's the average of those residuals? It's 0. On average, there's just as many dots above the line as there are below. Right? So the average of the residuals won't tell me anything. I can't tell if it's big or little. So I need a variance of it. I need the average of the squared residuals. That's a variance. Not standard. The residual is just the residual. It's this point minus what it would have been. Right? That's the distance. And you can do that again in Excel. You get a whole row of the predicted value and the actual value. And if you took an average of that, you get 0. If you took that and squared it and then took the average, that's called the variance. And then if you took a square root of that, that's called a standard deviation.
So if you square that column, that becomes the variance, but then take the square root of that, then
that's the standard deviation. And not just squared, if you took the average of the squared.
Oh, it's the average of the squares. Okay, that was
Yeah.
the step I was missing. I don't understand how you can square it and then take the square root.
Right, because then it would be the same thing.
Right, okay.
So does everybody kind of see mentally what I just described? If you just took that column and you just averaged it, on average it's 0. There's just as many positives as negatives. But if you square them all, you get rid of all that. And so then what? We'll take an average of that. That's called a variance. And like every time you hear about variance, it's always the average of the square deviations, always. And then when you take a square root of that, it brings it down to a unit you can understand. So that's statistics in like a giant nutshell. That was like all of Stat 101 in 10 minutes. Right? So what do we do with all this? Well, as you add stocks to a portfolio, and this becomes that portfolio P, right? Some portfolio. You find these numbers shrinking like closer and closer and closer to the line, but you can't get rid of the line. You're still going to have a slope. So you can do away with all this uncertainty. You can keep bringing them in so that they're all right here, but you can't get rid of it altogether. You still have some level of variance. And what we've discovered is somewhere around the 20th stock, it's right around 20 stocks, that you are going to eliminate about as much as you can eliminate. and adding a 21st stock and a 50th stock and a 150th stock, you don't get a whole lot more tightening of that dispersion. That's what happens. And so you find mutual fund managers who sell funds called something like the Janus 20, right? They're playing on that. They're just telling you, we're going to just do 20 stocks because it's hardly worth our investment money to do 21. There's a whole, so all this stuff you hear about in the mutual fund industry all grew out of this, right? This is the grad school portion of it. And then you are to take that information and do the application side, which is what do you do with it in real life. But this is the grad school portion of investing. All of this comes from somewhere.
So like in the portfolios, so the beta is just the risk of that asset in relation to the market.
That's all it is. It's how sensitive that asset is to the market.
And is that manager's, I guess,
yeah.
really his
how much more
ability, right? How much of it's due to the manager.
Yep.
And then I guess the other one that's floating out there, I don't know if we'll get to it or not, is the coefficient of determination. And that's really kind of how much of the return of the portfolio is basically.
Okay. Yeah.
Is that a kind of simple?
Okay. Yeah. I think we need to look at that one just a little bit more carefully to be able to put it in a nutshell like that.
Why is it then that every mutual fund I've ever dealt with had more than 20 stocks?
Because they are trying to replicate the market. I'm just saying that those that want to take advantage of this idea, you'll find that they will not replicate all of them. They'll try and reduce the number of stocks so they don't get killed with transaction fees, saying that, okay, I don't need to have all 100 of the NASDAQ. I can have the top 15, and I've got most of the NASDAQ. I don't need to do everything and chew up all my fees.
Right, but I wonder why they're not many managers that are doing that. Why they're all.
But there are some.
There's some, but the majority of.
Large cap too, right? It's hard to do that in small caps.
Sure, you can't have enough money. Right. Right. You'll have too much market impact. But everybody else, they're really just replicating the market. That's all they're doing. It's just that some are saying, well, but I can do that and not have to take on 500 stocks worth of transaction fees.
Right, but what about, a sector fund?
Mm-hmm.
I mean, they have 100 stocks.
They'll have
I mean,
100 stocks in them.
At 20. I mean, why don't
right.
They could.
They could.
Right.
They could. Well, by stopping at 20, you've reduced your you've maximized. You've done as much diversification benefit as you can.
Right.
It doesn't mean you can't still manipulate your expected return. It's just you're not going to get any more diversification benefit for it. You're still going to get return. You're still going to have risk, but you're not offsetting anything any further. That's all that's saying. Any other questions? Do you love it? I do.
You said that counted for Statistics 101. Can you maybe put me in for grade replacement from?
Oh, is that what we need? But that is, right? That was what you learned in Stat 101. You learned means, medians, variance, and so on. All right. I apologize that I wasn't very responsive this past week. I was traveling a lot, which is why I could not finish the grading, but I promise I will get caught up now that I'm back home. We have, I need to let you go, so you have a break. We have class next week, the 14th. I may talk a little bit about the efficient market hypothesis. I don't think I need but maybe 5 minutes of that. We'll do bonds next week. Monday the 22nd is our last actual class, but the Saturday before it is our Saturday. That's our day. And that Saturday, I will be talking through whatever topic I haven't gotten to yet that I know I can't get to that following Monday, but I want to save the afternoon for the project. So that afternoon, I want to work through the project. So those of you that need my attention on the project, bring your computers that day. We will be in here. You can do almost the whole thing right here. Okay? So you'll be able to walk away with almost all of the calculations done. And those of you that know how to do it, you are invited to stay and then be the TAs in the room, moving about the room and helping classmates. Okay, so that's my goal. So all this stuff that I keep saying, you're going to do this in Excel, you're going to do this in Excel, all that, don't be frightened. That's what we're going to do that day. We're actually going to work through them. All right? So no worries. Thank you.
Will you be doing them on the exam?
You will not do it on the exam. What you do on the project is it. I don't need to test it twice. All right? All right. Thank you. I'll see you next time.
So,
Did I do something wrong?
no. But